Hi everyone, welcome to my first ever YouTube tutorial. Just a quick disclaimer, I'm not a professional, so don't take my advice as financial advice. And certainly please don't sue me if you lose a bunch of money. Just a side note, um, I'm well aware that I'm not good at explaining stuff. So yeah, please bear with me. I'll try my best. Let's get back into it. As you probably already know, that there are a lot of investors that are talking about a bull trap, right? So what bull trap basically is that let's look at the year 2000 and year 2001 financial crisis. So a bull trap basically is a forced reversal. So it looks like it was going up, but it didn't. It went down more. It looks like it was going up, but it went down even more, right? So yeah, that was what they were expecting initially. Like this was the bull trap, but turns out it wasn't. It went down more. It went up more. So how do we profit regardless of where it goes, right? So this is what I would do personally. I think it's gonna be a bearish market, but I can't be 100% sure. If anyone tells you that they're sure of where the market's gonna go, they probably are lying, or they just don't know what they're talking about, right? For example, with the current situation, there were lots of bad news coming out, right? But somehow the market just went up more and just keep going up. It just doesn't make sense at all. It doesn't obey by any rules at all, not even the fundamentals, it seems. So as much technical analysis we could use, we can't be 100% sure of everything. The market doesn't obey by any rules at all. It only obeyed by one rule: supply and demand, and that's it. And Trump could randomly pull out like a wild card, and the market's just gonna go wild. So yeah. Anyway, so assuming at the moment that the market is not open yet, so let's just assume that it is open now and it's trading at 2800s, right? So I'm gonna put one unit of short position, right? So one unit of short position at where the price is at the moment. Okay. So assuming that that the trade is locked in, right, at one unit. So here, right? So I'm shorting one unit at this level. So what if it goes up, right? How am I going to protect my trades? If it goes up, I'm going to lose money, right? Because I'm having a short position open. So how I want to protect my losses is that I'm gonna put a long position of 2 units using a stop entry order. So what a stop entry order basically is that if the market price reaches this value, it will trigger the trade to put in the 2 units of a buy position, which means buy position, what it does is that if the market goes up, you make money, right? If the market goes down, you lose money. So that's going to be a buy position. So at this level, what I want to do is put a buy position at the top of this candlestick, the previous high, right? So yeah, this roughly is it. So I put a 2 units of buy position, stop entry order here. Okay, so this is not triggered yet. This long position is not open yet. It will only open when the market reaches this point. And let's just assume that this one is already open. My short position is already open. Alright, so to illustrate it, okay. So let's say I have a short position at 1, okay. And the market, instead of going down, right, which is what I was expecting. So if it goes down, it makes money. Goes up, you lose money, right? So it goes up instead, right? And it triggers my long position of 2 units. 2 units. Here, like I showed you, 2 units. 2, to 1, right? So if the market continues to go up, right? The market continues to go up, your profit from your long position will be more than your loss from your short position. Because the short position is basically you're betting against the market. So it goes up, goes up, goes up and up. Eventually, at some point, you're going to break even. At some point, you're going to break profit. Right? Yeah, obviously, you know, a lot of things could happen. So what if the market goes down, goes down, right? So what you want to do is, let's say it went up, it triggered a long position, and it goes down again, right? So what you want to do is when the market triggers the long position already, you immediately put a stop entry order at the same price at this level, right? That was 2836. Okay, so that's 3 units. Yeah. Oh, sorry. Low. Oh yeah. So what it does is that, let's say it goes down more, right? It triggers the short position of 3, the stop order of 3, and if the market continues to go down, your profit from your short position would be more than your loss from your long position. And what if it continues to go up? So how you determine what price you should put at your stop order is that you add up both of add up whatever you have at the short position. 3 plus 4, 3 plus 1 is 4. 4 times 2 is 8. So 8 minus 2 equals 6. Because what you want to achieve is that your total should be 2 times of the opposite position. So 2 plus 6 is 8. 3 plus 1 is 4. 4 times 2 is 8. You know what I mean? So 2 times of this. So it goes up even more. If it goes up, eventually you will break even again, and eventually you will break profit. So rinse and repeat, right? So now let's assume that it goes down. So I'll give you 5 seconds to think of what short order you should put, what short order value they should put here. All right, I'm sounding like Dora the Explorer, but yeah. So 2 plus 6 is 8. 8 times 2 is 16, right? 16 minus 3 minus 1 is 12. So your short position will be 12. And it goes down more, you're gonna break even, and eventually, break profit. Yeah. So I hope this makes sense. But my advice to you is that make sure you have enough margin to execute all each trade, because and if you have like a smaller account, right, I would advise you to, let's say it breaks even, I would advise you to close it immediately and start a new position with 1 and rinse and repeat, because you don't want to blow up your account. The only way you could blow up your account is that you leave it open and then it goes up again, and then it's gonna go a sideways market, it's a sideways market. Then you're gonna use up a lot of margin, and eventually it's gonna blow up your account. So yeah, make sure you manage your risk well, and basically that's the method of hedging. So if you have any questions or you know any like disagreements with my method, please do comment. I'm an open-minded person. I wouldn't say that I'm always 100% right. I'm always open to different ideas, challenging ideas, different ideologies of trading or whatsoever. I'm always learning and learning and learning. But I personally believe that this method is going to work at the current climate because it's going to be volatile, especially when a quarter two reports are out. It's going to be volatile. It's going to go up a lot or go down a lot. So you have to set up the proper trigger points, like make sure they are at the same level. So I'll just explain it here. So imagine that you have like a short position of 1 unit, right? Then the market goes up here. Then it triggers the long position of 2. Okay. So once it triggers, once you know it triggers, immediately you put a stop entry order of 3 at the same level as this. So stop entry. So if it continues to go up, right? Sure, you make a profit. But if it continues to go down, if it goes down again, you trigger this position. So you could hedge it well. So yeah, that's all. Thanks for listening. Good luck. Stay safe. Bye.